Which is why I'm delighted to say that we have Peter Schiff to answer this question for us. He's CEO and president of Euro-Pacific Capital. He's a financial analyst. He's an author. I think most importantly, though, at least to me, is he was one of the few financial analysts to predict the collapse of the housing bubble. Everyone else was like, housing prices have gone up. They just keep going up. It's never historically dropped. And he said, look, it's going to collapse because it's not sustainable, because he understood what it was about money that caused these bubbles in the economy, and he knew it was going to collapse. Analysts running the gambit laughed at his face, and when he was proven correct, we're now left picking up the pieces. But unfortunately, we still are not understanding what it is that caused the crisis to begin with, so our policy prescriptions are kind of off base in terms of dealing with the aftermath. So I'm delighted to welcome, and I hope you will join me in welcoming Peter Schiff.
Thanks everybody for coming. Hopefully most of you are not here for the free desserts. But all right, let me talk a little bit about money. I'm going to turn my phone off just in case somebody decides to call me. I'll just put it on silent. Anyway, everybody else, I guess, can do the same thing. Yeah, one of the roles of money, as you just alluded to, is that money needs to represent a store of value. And the reason that that's so important is because that facilitates savings, right? You're not going to save money if you anticipate that its value is going to erode over time. So you need something that has a store of value. And the reason savings are so important in a market economy is because, contrary to the conventional wisdom, spending is not what grows the economy. People who believe that are basically putting the cart before the horse. What actually grows an economy is the opposite of spending. It's underconsumption, it's savings, it's the money we don't spend that makes the economy grow. Because when we don't spend it and it's saved, that money is available to finance capital investments, business expansion, job creation. All the things that grow the economy flow through from savings. You know, a popular refrain, you know, with the Occupy Wall Street crowd, when they say, you know, the businesses don't create jobs. You know, when you say we're going to tax the job creators, they say, no, 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 the job creators are the consumers, because they're the ones that are spending the money. And they say, well, if there were no customers, then there would be no businesses. But of course, what that theory overlooks is, where do the consumers get the money, right? They get it from their jobs. So you can't say that consumers create jobs when you need jobs to have consumers. So it's the other way around. And what gives the consumer purchasing power is his productivity. Right? If everybody just had a job from the government and the government printed money and gave it to people, that wouldn't, you know, there'd be no demand because there'd be no supply. There'd be nothing to buy because nobody would be working. What creates the purchasing power is the production. And the production comes from productivity. And what makes workers productive is capital. It's the tools and the equipment that they have. If they were simply using their hands, they couldn't produce nearly as much. And all of that capital, all of those tools, are only here because of savings. So savings are very important. And also, savings help determine the rate of interest, because interest rates are a very important aspect of money, because interest rates represent a price. And like all prices, they are determined by supply and demand. The supply is all the savings. The demand is all the people that want to borrow money, whether it's businesses, whether it's college students, someone wants to buy a car, the government. Everybody borrowing money is competing for this store of savings, because for every dollar borrowed, somebody had to save that dollar. Somebody had to not consume and put that dollar in savings so that somebody else could spend it or invest it. And so if you have a lot of savings, right, then you're going to have lower interest rates because the supply is going to be greater. And what does that mean? If there's a lot of savings, what economic signals is that sending to the market? If people are saving a lot of money, what that says is that people prefer future consumption to current consumption. Because after all, when you're saving money, you're just deferring consumption. Every dollar you save is going to be spent eventually, except you're not going to spend it today. You want to spend it tomorrow. And hopefully you'll spend the dollar tomorrow plus all the interest that you earned over time. And so it sends out signals. that if there's a lot of savings, that there's low interest rates, and then of course the economy will react, investments will be made based on the fact that consumption has been deferred to the future. And also, one of the reasons that people might save in a free market economy is, in a free market economy, contrary to, again, the conventional wisdom, prices go down. Right? The natural tendency in a free market is deflation. Prices go down. Prices went down for almost the entire history of the United States until the Federal Reserve. Our grandparents will tell us stories about how cheap things were when they were a kid. Well, their grandparents or their grandparents' grandparents told the opposite stories, how expensive things were when they were a kid and how much cheaper they are now. And the politicians try to tell us that, no, inflation is a good thing, money losing value is a good thing because the economy would collapse if prices weren't rising. They try to make us feel that falling prices would be a disaster, when of course it's the opposite. Falling prices are a reward for capitalism. They make wages more valuable. They make savings more valuable. The argument is that, well, if prices are falling, nobody is going to buy anything. They'll just be waiting for lower prices, and of course that's absurd. We all have cell phones. We all have laptop computers, we all have plasma TVs. The prices for those items are falling all the time. That doesn't stop people from buying them. In fact, it encourages people to buy them. If cell phones were still as expensive as they were when they first came out, nobody in this room would have one. The reason that we buy them is because the prices are coming down. So it's the exact opposite. Falling prices create demand. It's not the other way around. But that's another reason that people save. If you save your money and money gains value, you can buy more stuff in the future, not only because you earned interest, but because things got cheaper, the money became more valuable. So if you have a lot of savings, you can have low interest rates. If you don't have a lot of savings, well, you're going to have high interest rates. And the beauty of this is, let's assume that there's not a lot of people saving money, and a lot of people want to borrow money. Well, you have a very limited supply. You have a lot of demand. What happens to price? Price goes up, so interest rates go up. Higher interest rates discourage people from borrowing because it's more expensive, and they encourage people to save. And ultimately, the market's going to create an equilibrium between savings and debt, and you're going to have a market rate of interest. And investments are going to be made, capital projects are going to be made that can be adequately financed. Now, the problem comes in, now that we don't have real money, and you don't know what that is, now that we have fiat money or a money substitute, the Fed can create money out of thin air. Now, when they create money, they don't actually create any value. They're just printing money. So they diminish the value of the money that already exists. But also, when the Fed creates money, they do it in a way where they buy up treasuries. And they also control short-term interest rates, the cost of money to banks. And when they do that, the Federal Reserve can bring down interest rates. And that has the effect of sending the same types of signals to the market that there's more savings, because interest rates are low. But people aren't saving their money. There is no real change in time preference for money. It's the same. And so you send out this false economic signal to the market. And as a result of that false economic signal, a lot of investments are made that really should not be made. There's no real viability there. But they're made because of the false signals. And I often joke, when the housing bubble burst, and one of the things that President Bush said at the time was he blamed everything on Wall Street. He said, Wall Street was drunk, and they did a bunch of stupid things. So of course, yeah, they were drunk, but he never asked the question why. Where'd they get all that alcohol? Why were they drunk? And they were drunk because the Fed liquored them up. Alan Greenspan kept interest rates very, very low for a long period of time. And just like anybody, if you're drunk, you're going to do some stupid things while you're drunk. You don't realize it until you sober up the following morning. And so this is what causes this business cycle, right? People think that the business cycle is just some flaw in capitalism. Just for some reason, we have these booms and busts. And that's not the case. These booms are caused by the malinvestments that are created in response to the Fed intervening in money supply, where you have the Fed price fixing interest rates, creating too much money, and fueling these bubbles. And one thing all of these bubbles have in common is debt. A lot of them are financed by borrowing money, particularly the housing market. Obviously, what made it possible for people to buy houses they couldn't afford, other than Freddie and Fannie or the FHA that might have been, guaranteeing the mortgages was the fact that the interest rates were so low. When people buy houses in America, they buy them based on the monthly payment. And the monthly payments were a function of the mortgage rate. And especially when you got an interest-only mortgage, where the only thing you're paying is the interest, then the low interest rates really made it cheaper. And when you had the Fed with interest rates at 1% and the banks were offering teaser rates based on those temporarily low interest rates, people could really get in over their head. So this was a function of money being too cheap. Instead of the market setting interest rates, you had central government planners at the Fed picking an interest rate. And why did they pick one that was so low? Well, the reason is the politicians like the boom. Right? They like it when people feel good, when voters feel good, because they're more likely to reelect the people who are in office if they feel good. If they think they're getting rich in housing, if they think they can get rich without working, they're going to be happy, especially if you're taxing them so much on what they earn. If you can create the illusion that they're making money in the real estate market, well, then they're not going to be as upset at all the taxes they have to pay. So the politicians like the boom. In fact, everybody thinks that the boom is what's good. And then when the minute you have a recession, what does Congress want to do? What does the president want to do? We need a stimulus. We can't have this recession. We need to stimulate the economy. Well, they don't understand it. The stimulus is why we have a recession. Right? The stimulus is what caused the boom. But the boom is the problem. The boom is where all the mistakes are made. The recession is where the mistakes are corrected. Right? That's where the cure takes place. So we need the recession. Now, when people say we need the recession, they'll try to say, oh, you're heartless. You're happy that people are suffering. No, it doesn't mean we're happy about it. It just means it's necessary. It's like if somebody checks into rehab because they're a drug addict and then they're going through withdrawal, that doesn't mean that the rehab center is happy that the people are suffering through withdrawal. They just know that if they want to get healthy and kick the habit, that they're going to go through withdrawal. That's just part of the cure. You know, if when you checked into rehab, every time you started having withdrawal symptoms, they gave you drugs, right? You're not going to get cured. You might be popular. You might be a popular rehab center if you're giving out drugs to everybody, but not because you're curing anybody. And so what happens is the minute the narcotic of the cheap money begins to wear off, right, and we realize the mistakes that we made, people are like, you know, I can't believe I bought that condo. You know, I can't believe, you know, how do I buy that internet stock? You don't see this when it's the mania, but the interest rates eventually rise, and the mistakes. And so what happens during the recession is the market tries to correct all these imbalances, because during the boom, resources are misallocated. Capital, labor, right, is misallocated. In the housing bubble, right, too much capital went into building homes, remodeling homes. Too many people were buying all sorts of furnishings for their homes, buying cars based on home equity loans. Too many people were working in the mortgage industry, in the finance industry. There were, you know, people had jobs where they shouldn't have gone. Because the whole idea behind an economy is to allocate the resources, which include labor, but capital and land, in a way to maximize productivity, to maximize our enjoyment and our utility from these resources so that we can have a rising standard of living. But if capital and labor and land are where they're not supposed to be, right, that you have to correct that. And what does that mean? What happens when the bubble bursts? Well, people that made bad investments lose money. People that have jobs that they shouldn't have, you know, they have to lose those jobs so they can get other jobs. You see, a lot of times in Washington, people don't differentiate between jobs. They just think as long as people have a job, it's okay, right? If somebody has a job digging a ditch and someone else has a job filling it back up, as far as Washington is concerned, they're both employed. But they're employed doing what? What do you have to show for the labor? Nothing. You know, you filled the hole in the ground. You have exactly what you had before they started. We don't want jobs because we want jobs. Jobs are not an ends. Jobs are a means. What people want when they have a job is they want all the things that they can buy with their paychecks. But you can only buy stuff if something is produced. So people have to be employed productively. That's the key. You know, in the old Soviet Union, you know, before it collapsed, one of the things they used to brag about is that they had no unemployment. They would tell their citizens, look at these Americans, they have all this unemployment, but nobody in Russia is unemployed. Of course, yeah, everybody worked for the government. Everybody had a job. But, they had to wait in line for 6 hours to buy some bread or whatever, because nobody was baking bread. Everybody was working for the government. And so if no one is producing anything, then your salary doesn't have any value, because that's just money. You can print money all you want. That's not the solution. I mean, a lot of people now talk about the fact that we don't have enough demand. Right? You hear all the Keynesians are saying that the problem with the economy is that Americans are broke, they have big mortgage debt, they have car loans, they have student loans, so they don't have any money, and so the government needs to print money so we can have more spending. Right? But if you're broke, just adding money isn't going to change the circumstances, because money in and of itself doesn't have any value at all. It's just a little piece of paper. They're broke because they're loaded up with debt and they're not productive. And more money isn't going to change that. Or if the government, they'll say, well, the people are broke, so the government has to spend. Spend what? If the people are broke, the government is broke. Where does the government get the money? It doesn't get it from the moon. It gets it from the people. So if the people are too broke to spend, the government's too broke to spend, because the government has to tax them to get the money. But one of the problems with the monetary system we have now is that people think, well, we don't have to tax them to get money. We could just print it. And then we can spend that, as if there are no adverse consequences to printing money. Because that's a tax, just like anything else, except instead of taking your money away from you, what that does is take the purchasing power away from your money. So you don't necessarily see the tax, but you feel the tax. But when you go to the supermarket and groceries are more expensive, or you go to the gas station and gasoline costs more money, a lot of people don't make the connection. They don't see that that's a tax. Especially when you have the government or the economists blaming the high prices on a greedy oil company, or on OPEC, or on natural disasters, on bad weather, on the flood. So they say, oh, it's not the government's fault. And then you'll have the economists say, look, it's a good thing that the prices are going up, because otherwise we might have deflation. So this is the price that you have to pay to avoid deflation, is you've got to pay higher prices. So they don't make the connection. So it lets the politicians off the hook, because the public doesn't understand how all these benefits are being financed. Now, the other source of this big bubble, or this big problem, has to do with the U.S. dollar's role as the world's reserve currency. Up until the Second World War, all the countries were using gold. Everybody was on a gold standard, including the United States. And after the Second World War, America pretty much had almost all the world's gold. 90% or more than 90% of the world's gold was held by the U.S. government. And where did we get all that gold? I mean, we didn't mine it all. We got it because people used it to buy the products that we produced. And how did we produce all these products? We produced them because we were the freest country in the world. We had more capitalism and more freedom, and as a result, we were more productive. And the world wanted the stuff that we produced, yet they weren't productive enough to produce stuff for us, so they had to give us their gold. So we had all this gold. And we went around to all the other countries and basically proposed a new monetary system. And this was going to be where, instead of foreign central banks backing up their currencies with gold, they would back them up with a dollar. And the dollar, though, was backed up by gold. Of course, that's the only reason it made sense. If the dollar was backed by nothing, then we couldn't have conned the world into signing up for this arrangement. But everybody knew the dollar was as good as gold, and if you had $35, you'd get 1 ounce of gold. That was the deal we made with the world. And what was in it for the world was, if they held dollars, they got interest. If they held gold, they had storage costs. So it made sense. Hold the dollars. We're on a dollar standard. The dollar is the reserve currency. The dollar is backed by gold. America is the world's richest country. They have the biggest trade surplus. They're the world's biggest creditor nation. They've got all the gold. Good deal. Well, it was a great deal for us, because the minute we got that privilege, we abused it. Because now all of a sudden, we could pay for our imports by printing money. Now, technically, we were supposed to have the gold to back it up, but that didn't stop the government. They just lied, right? They wrote checks that they couldn't really cash, assuming that people would just not care or not notice. Well, after the 1960s, when we had the guns and butter economy, the war on poverty, the Great Society, we went to the moon, Vietnam, all this stuff, we were running big deficits. And some of our creditors began to notice this and realize that we couldn't possibly have enough gold to back up these IOUs, which is what the Federal Reserve notes were. They were promises to pay real money. The real money was the gold that the Fed had in its vaults. So rather than acting responsibly, rather than devaluing the dollar and allowing a deflation to occur, and cutting government spending and doing the right thing, the politicians did the expedient thing, but almost an unthinkable thing, and they defaulted. Nixon basically told our creditors, we promised to give you gold for your Federal Reserve notes. We're now going to give you nothing. You know, you can hold on to them if you want, but you're not going to get any gold. And, you know, the world should have gone back on a gold standard at that point, right? But they didn't. Now, they marked the dollar down rather dramatically. The dollar was marked down by about 2/3 during the 1970s. The Deutschmark, you know, when the 1970s began, you can buy 4 Deutschmarks for the dollar. At the end, you can get about 1.5. The Swiss franc went from like 23 cents to 75 cents. The yen used to get 360 yen to the dollar. Later in the decade, it was down to like 150. Of course, you know, it's a lot lower now, but that was a big drop during the 1970s. Oil prices went from $3 a barrel to $30 a barrel. I mean, that's why oil prices went up. It wasn't because of the Arabs. It was because of Nixon. It was because of what the government did. It was all the money we printed. Money lost value. Oil prices didn't go up at all. But in terms of you know, a depreciated dollar, oil went from $3 a barrel to $30 a barrel. And you know, gold prices went up from 35 up to over 800. Another thing happened too during the 1970s. A lot of women came into the workforce, and it wasn't because they were liberated. In fact, they were liberated before. But as a result of all this inflation and all these taxes, their husbands could no longer afford to support them, so they had to start working. You know, our standard of living declined dramatically with the loss of the purchasing power of the dollar. And in fact, you know, I mentioned that oil I often use as an example. I think I even used it in that congressional testimony when people say, oh, you know, gasoline prices are so high now, we're paying almost $4 a gallon. These are, you know, record high prices. Say they're not. They're actually lower than they were in the 1950s. Well, what do you mean they're lower? Well, you know, back in the 1950s, you know, you could buy a gallon of gasoline for $0.25. So all it cost 25 cents. Well, if you have a 1957 Chevy and you scoop around in the seat cushions and you find a quarter that was dropped there in 1957, you can still buy a gallon of gas with that quarter. You get change too, because it doesn't cost that much. It costs less because real money held its value. The only reason that oil is more expensive is because we're paying for it with depreciated dollars. That is a problem. What was I talking about before I started talking about that? I just lost my train of thought.
Standard of living.
Yeah, well, okay, so the standard of living went down dramatically after the 1970s. But even though the world marked down the dollar, after it collapsed, it stabilized. It stabilized when Paul Volcker came in and interest rates went up to 20%. Ronald Reagan came in promising to reduce government and lower regulations and cut government spending. And that created some confidence in the dollar, and it kind of stopped the hemorrhaging. And the world then began to continue to function. The dollar was still the reserve currency, even though it was backed by nothing. And that is the problem, because the whole idea is if the Deutschmark wasn't backed by gold, it was backed by the dollar that was backed by gold. But if the Deutschmark is backed by the dollar and the dollar is backed by nothing, then the Deutschmark is backed by nothing. So that's when basically we embarked on this giant experiment that has failed every time it's ever been tried in fiat money. The whole world is on this fiat money system. But of course, once the world knew the dollar was backed by nothing, now it was so much easier for the government to run deficits. Much easier than when they had to pretend it was backed by gold. At least back then, you know, when Lyndon Johnson was doing this, he had to worry that somebody might figure out what was going on. But once we basically told the world, you're going to get nothing for your dollars, then there was no limit to how many we could print. And that's when the U.S. economy began this massive transformation from the world's biggest creditor to the world's biggest debtor, from the world's biggest manufacturer of low-cost, high-quality stuff. I mean, all the low-cost merchandise was made in America. Everything, even though we paid the highest wages in the world. Right? If something was expensive, if something was imported, that meant it was expensive. People used to brag about the fact that they can afford to buy imports. If you bought imported products, it meant you were rich, because everything that was imported was expensive. All the bargain basement stuff was made here. And it wasn't because we had low labor costs. We had the highest labor costs in the world. But our workers were the most productive because they had the most capital. They had the most tools and the most equipment. And our businesses had the fewest regulations. So it was freedom that made us prosperous. But all that changed, and we began to live off the printing press. Because when the dollar can be just printed out of thin air and the world is going to take it, we can buy all these products from our trading partners for nothing. You know, when the Chinese are making things for Americans, they need land, labor, and capital. People have to work hard in factories to produce stuff. What do we give them in return? Just some money that we ran off a printing press. And what do they do with it? Nothing. They can't even spend it. All they can do with it is loan it back to us and buy treasuries. And then what are treasuries? Just more dollars. And a lot of people, again, they confuse this. They think that the Chinese are benefiting from this relationship. They're not gaining at all. We're benefiting, right? We get all the stuff and they get all the work. Well, what good is the work without the stuff? See, we're trying to say, well, they get jobs. Well, so what? The slaves had jobs. It wasn't a good deal for the slaves. These jobs are not a good deal for the Chinese if we get all the stuff that they produce. Right? They're working. The whole idea behind exporting is not to create jobs. It's really to eliminate jobs. I mean, the reason you export is to import something else, right? Because you want to consume. And how do you consume as much as possible? Well, if there's something that you can do really well, that you can make more efficiently than somebody else, rather than try to make everything, you just make the things you make best, and then you trade for the things that other people make better than you. But the whole reason to export something is so you want to buy something else. You don't export just so you can have a job. You're just wasting your labor. Now, what happens when we trade with the rest of the world, they send us stuff, and what we basically say is, well, I got nothing for you. But I got an IOU, dollars, will you take the IOU? And they take it because it's the reserve currency. And maybe in the back of their mind, or I guess in the front of their mind, they figure that one day they can use it to buy something. But meanwhile, what are they going to buy? What are we making? Every year we make less and less stuff that they want. The stuff that the Chinese want to buy is all made in China. I mean, that's where the stuff that we want to buy is. But this whole thing is maintained. But now we have this entire bubble. We have this entire phony economy that is now predicated on Americans borrowing money that they didn't save to buy products that they can't afford and didn't make. And this whole thing is phony. And all of our economic policy is designed to sustain this. Nobody wants to allow it to be corrected because the correction happens in a recession. We have a lot of problems. The biggest problem in the U.S. economy is that interest rates are too low. Interest rates have to go up. We're never going to have a recovery. We're never going to have real economic growth. We're never going to create productive jobs unless interest rates go up. But that's going to be very painful because we're so overly indebted. What's going to happen when interest rates go up? Well, banks are going to fail. And they're not going to be able to, next time we can't bail them out. What's going to happen to the housing market? It's going to go down more. It needs to go down more. That's part of the correction. Prices were too high. They're still too high. What about the government? What's going to happen when interest rates go up? Well, the government is going to have to dramatically reduce spending. In fact, they might have to default on the bonds they've already sold. Because the only reason the government can pay the interest on the debt is because the rates are really, really low. Well, what happens when rates go up? Well, they can't afford it. We can no more afford to pay our bonds back than the Greeks can. For a while, interest rates in Greece were at record lows, and the Greeks had no problem. But then interest rates went up, and now you have a crisis. The same thing is going to happen here. Now, there are people that think, well, that'll never happen because interest rates are never going to rise. Well, that's just impossible. They have to rise. What is the consequence of keeping interest rates artificially low? We continue to screw up our economy. Instead of allowing market forces to correct the imbalances, we make the imbalances bigger. Right? The more we stimulate the economy with the toxin, because that's what the stimulus is. It's a toxic sedative, and eventually you overdose on it. Right? What is happening? If we keep interest rates low, nobody's going to save. I mean, who's going to save money that's depreciating in value? Right? So you're going to destroy your savings. You're going to destroy the ability of the economy to generate capital, to generate growth or production. You're going to create massive inflation. Now, the government can lie about inflation for a while. They can hide it behind these doctored up CPI numbers that are so, mechanized, or they're so manipulated. Not, there's a conspiracy, but the formulas that they use to calculate prices going up are flawed. They're deliberately engineered to get a low number. I mean, that's why they're there. But of course, when they're measuring prices, they're not even measuring inflation. They're measuring an effect of inflation. But at some point, the inflation is going to be so pronounced that its effect on prices is going to be so great that the government is not going to be able to pretend that it doesn't exist. And then at that point, interest rates are really going to have to rise, and then it's all going to hit the fan. And as I said, that's when the banks are going to fail. And the next time the banks fail, if the Fed is doing the right thing and raising rates, that means not only do the banks fail, not only do the bondholders lose money, but the depositors lose money. Because if the government is having trouble paying its own debts, how's it going to bail out the FDIC? Where's it going to get that money? So there are tremendous losses. All we're doing now, all of our policy is designed to postpone the day of reckoning beyond the next election. That's all Congress cares about. How can we get through 2012 without it hitting the fan? And they don't care that the policies that they're pursuing are just making all the problems worse. And when we look at the economy, and people say, oh, the economy is growing. Look at the GDP. The economy's not growing. We're spending more borrowed money. That's not economic growth. Look at the debt. In the last few years, right, since Obama's been president, look how much the debt has skyrocketed. It's grown by much more than the GDP. So all this consumption has been financed with debt. It's not real prosperity. It's phony. It's like looking at half of a balance sheet. You're looking at the assets and you're ignoring all the liabilities. Or on an income statement, you look at the income, but you don't look at the expenses. We are not better off because the GDP went up. We're worse off. Where'd that money come from? We borrowed it. And what did we do with it? We spent it on consumption. We didn't invest it. We don't have more plant and equipment. We blew it. Right? The government spent it. The bubble that we had as a result of the cheap money that the Fed created in the 1990s, that inflated a stock market bubble. When that bubble burst, instead of letting the market correct the problem, we deliberately gave us more stimulus, and that created the housing bubble. When that bubble burst, instead of, again, sucking it up, admitting that, gee, we really screwed up after the last bubble, let's do the right thing now, let's let the market run its course, instead of doing that and taking a more painful recession, which was now necessary because we didn't take our medicine the first time, they did the same mistake, and now they're inflating a government bubble. The government bubble is bigger than the housing bubble. It is bigger than the stock market bubble. And it's going to burst. It's no more sustainable than the previous bubbles. And you can see it in the bond market. You can see it in the currency market. But the real crisis that's coming, and then I know I've been talking, we'll take questions. The real crisis that's coming as a result of the fact that we no longer have sound money, that we've been printing all this money and running all these huge imbalances, is a sovereign debt crisis, a collapse in the U.S. government bond market, a collapse in the dollar on a much grander scale than what we see playing out right now in Europe. And if you remember, when the housing bubble first began to crack and the signs showed up first in the subprime market, all the experts, everybody, from the administration down to Wall Street, was on television reassuring everybody not to worry, that it was all contained. It was just a subprime problem, tiny little problem, don't worry about it, the market is sound. Of course, at the time I was saying that that's not true. It's not a subprime problem, it was a mortgage problem. That we were just seeing the symptoms first in subprime, but the symptoms were there. And it wasn't even about contagion, about spreading. Everybody was already sick. It was just a question of time before the symptoms showed up. Well, the same thing that's happening with sovereigns. This is not an Italian problem or a Greek problem or an Irish problem. It's a debt problem. And we've got more debt than Europe. Just because we can print money and we have the world's reserve currency doesn't mean that we're immune from these laws. Right now, I think, this is a time in history where the sovereigns are being held accountable. Just like the Italians or the Greeks have borrowed more money than their citizens can repay, American government has borrowed more money than Americans can possibly repay. And, we're not going to pay the debts off by raising taxes on the 1%. We can't even do it by raising taxes on the 99%, as if we can even extract all that revenue. It's going to have to come through a restructuring. It's going to have to come through a default, one way or another. And there's two ways that can happen. We can legitimately default, Congress can level with its creditors and say, look, we're not going to pay 100 cents on the dollar on these treasuries. It can level with people who are expecting a government pension or a Social Security check and level with them and say, look, the money's not there, we can't pay you everything that we promised, and we'll come up with some way of means testing it or doing something so that we can make do with less. Or they're going to inflate the currency into oblivion. And it won't just be not worth a Continental, it'll be not worth a Federal Reserve note. Because one way or another, the people who loan money to Americans are going to lose. The savers are going to lose. The creditors are going to lose. Either they're not going to get their money back, or the money they get back isn't going to have much value. But the problem is, the longer we wait, the worse it's going to be for everybody, and the more damage that we do to our underlying economy. Because the longer we allow these malinvestments to build up, right, the bigger the impact when they collapse, and the harder it is to restore balance. And part of that would be going back to sound money, going back to a gold standard. I'm confident that the world is going to go back on a gold standard. The question is, how much longer is it going to take, and how high is the price of gold going to be when that happens? But if we go back on a gold standard, then we will have discipline again in Congress, because Congress won't be able to spend money unless they can extract it from the taxpayer. They're not going to just be able to print money. We're not going to be able to run all these trade deficits. If we want to import, we're going to have to export. If not, we're going to have to settle our accounts with gold, and if we can't mine the gold. And so that is what's going to bring everything back into balance. You know, the longer we wait to do it, the more mistakes we make in the interim, the harder it's going to be. And the real threat to our liberty is that this real crisis that's coming, and the economic collapse that's coming, and the financial crisis is going to be much worse than 2008. The problem is, all these problems result from government. They result from government meddling in the economy. All these distortions that the regulations and the subsidies and the money printing create. But the government is very successful at blaming capitalism for the problems that it creates. It mixes capitalism with socialism, and then it causes a problem, and they say, you see, capitalism doesn't work, we need more government. And then they get more government, then we get more problems. Well, this is going to be such an enormous problem that we might end up with total government. You know, and completely change the fabric of our country. So I think it's very important that as many people in Congress as possible, and that's where you guys can come in, understand the root cause of these problems. And it's not because we have too much freedom and too much capitalism, but the reverse. Capitalism doesn't work when government distorts it and interferes with it, when it tries to micromanage it. That's where all the problems come from. The solutions are going to be in the market. Right? It's not going to be more government, it's less government. It's rolling back all these rules and regulations that are distorting the market and returning to sound money. And if we do that, we're going to have real economic growth. We're going to have real prosperity. We might have to, you know, suck it up and bear some pain. And just like, you know, you could swallow some bitter tasting medicine. It might not taste good, but if it works, you got to do it. But, you know, denying that you're sick, or just exacerbating or covering up the symptoms while you get sicker is not the way to go. But that's unfortunately what we're doing now. Anyway, let me just open it up to the questions.